Hi there, Etoro. It is Monday, the 18th of July, and that means it's time to take a look at what moved the markets last week. It's a scorcher here in London today. It might be the hottest day in London's recorded history, so I'm going to try to get through this quite quickly because I'm sitting under some very hot lights at the moment. First up, looking at the charts, it's not obvious looking at this just because it's so small. But the NSDQ100 experienced some volatility through the week. You can see these are the candles for those days. There was quite a large movement downwards, and then it recovered to end the week more or less where it started the week. And we can see that the case is very similar here for the S&P 500. For the past few weeks, I have been watching XLE quite closely. This is the energy sector fund, and the reason that I'm watching it is because it has a large effect or is affected by inflation expectations. And we can see, well, this is the opening today, but through the last week or so, it has been working its way downwards, even going so far as to break through its 200-day moving average, although it's now up above that number. If it moves below that level, then it's likely that the drop will continue, and the energy sector will then be in a downtrend, technically speaking. I also look at China each week, and we can see the CSI 300. There was a huge downtrend for many months that was broken. An uptrend began to form, but that has changed recently, and we'll take a look at why in a moment. If we zoom in a little bit to KWEB, which is an ETF of technology companies in China, you can see that the rebound has been less pronounced and the drop from that rebound has been a little bit larger. I also talk every now and again about the DXY, the US dollar currency index. And the reason for this is that a lot of foreign debt is denominated in dollars, and many things that the world buys are denominated in dollars. So when the dollar is very strong, as it has been over the past few months, and let's zoom out here to the monthly charts so we can look even further back. So it's the highest it's been since the year 2002. When the dollar is very strong, it creates havoc in international finance markets. There are some benefits to a stronger dollar for countries outside of the US, but the negative aspects of a stronger dollar far outweigh the positive aspects. And so if this continues for much longer, we might start seeing emerging market countries potentially defaulting on their debts to the US. I wanted to take a quick look at the specifics of commodities, and the reason that I am so firmly fixed on commodities right now. I don't always look at commodities week in, week out, but the reason I am right now is because the price increase in commodities and materials is a large factor in driving up inflation. So if these prices start coming down and coming down sharply, then we're likely to see inflation come down sharply off the back of this. We can see in terms of the week, these are just the commodities and materials that I follow. There are, of course, many others. You can see most of them are down on the week, and we're seeing a little bounce on the day today. The exception here is natural gas, which just keeps on going higher. This is US natural gas and is up 92% year to date. If we take a bit of a closer look at copper futures, so copper is thought to be highly correlated to the performance of economies. When an economy is growing, there's a big demand for copper. It's used in many things that we use day in, day out, and we can see that the price has dropped enormously from the highs that we saw just over the past few months. On the flip side of things, well, maybe not on the flip side of things, but oil is most certainly off of the highs that it has been sitting at for the past few months, but it hasn't dropped as sharply as some of the other commodities. And there are some good reasons for this. So as the world reopens and demand increases, as the war in Ukraine continues, there's a supply challenge in terms of providing enough oil for the world, for the things that we need, not just for fuels, but also for things like plastic, etc. Last week saw some very interesting economic data points, and so the first of these that I want to look at are the GDP numbers out of the UK. So this was a huge upside surprise, and I find this quite funny. It's the contrast in US politics and UK politics is pretty obvious. The UK and I think largely Europe tend to be quite pessimistic, or let's say more measured in the way they do things, whereas the US tends to be very optimistic. So there's the Fed saying that, we're definitely not going to go into recession, even though there's negative GDP growth now for 2 quarters in a row, and all of the other problems that we know about. Whereas in the UK, the Bank of England, our central bank, is certain that a recession is coming, and very soon. And this is in the face of things like GDP growth being higher than we expected. I also wanted to point out the media. Now, For those that watch my videos fairly often, you know that I'm not a big fan of the media. But you'll see on the 8th of July, The Guardian was saying UK economy is in crisis. And then on the 13th of July, just 5 days later, the headline is completely different. So the media got it completely wrong. But the other thing to remember is it's not just the media that was getting it wrong. It was the people closest to the data. I'm pretty sure the Bank of England didn't forecast a huge upside beat on UK GDP up until they had the data in their hands a few days ago. And so if the people that are very close to this data and know the inner workings of the economy and have huge resources at their disposal can't get it right, what hope do we have of getting it right? And this is why I tend not to trade very much, particularly around economic events. Sometimes I might, but I prefer long-term investment in strong companies. It feels as though the odds are more on your side in that style of investment. The other interesting piece of data that we got last week was this, which definitely moved the market. So CPI came in much higher than expected in the US. And the government in the US started setting this expectation about 2 days before. Obviously, they have access to this data before the general public does. And so we saw 2 days before that number came out, the government started saying these types of things just to set the expectations and so that the market wouldn't freak out as much as if that information had hit the general market cold. We could also see that they were playing down this headline number, and this is something that they haven't really done before. There are a number of ways to slice and dice the inflation numbers, but they tended to just stick to looking at the headline number, and that's it, because they know that that's the simplest way to look at it, and they know that that's the way the media and probably the general population will be looking at it. However, in this case, they felt compelled to come out and say that the June CPI number is already out of date. It's going to be highly elevated, but the reason that we shouldn't read too much into this data is that since this reading was taken, energy prices have dropped significantly. They even went so far as to say as they are expected to fall further. But we'll see if that part ends up being true. Now, following this, the markets did freak out, and that's part of the reason that we saw the volatility in the middle of last week in these US indices. A higher inflation number means a potentially more hawkish Fed, and so many analysts and market pundits started talking about the Fed potentially raising interest rates by 1%, 100 basis points at the next meeting. This caused a bit of a stir, but actually several members of the Fed then walked this back a little bit, saying the market's expectations are not aligned with reality. 100 basis points hike, is not entirely off of the table, but it's very unlikely, and it seems that the reading that we've had has just cemented the fact that we're going to raise by 75 basis points the next time around. And the market expected that, so they were okay with it, and so we saw a bit of a rebound in the market in the second half of the week. Now, looking at China, so there are several very bad things happening in China at the moment. So the first piece of very negative news is that Chinese GDP came in well under expectations, or GDP growth. But on top of that, we have lockdowns reappearing. China is sticking to its COVID zero policy. There seems to be a bit of a run on banks at the moment in certain provinces. And this very big piece of news is that home buyers have started boycotting mortgage payments. They're not making their payments en masse. And this is creating a problem for those borrowers, particularly since they already are in crisis mode, given the collapse of all of these big giant companies that we saw earlier in the year, and which continue through today. So now there is a worry that this is gonna spread through the financial system, but there is more recent news than this, by the way. And so it looks as though the Chinese government is stepping in to try and see how they can help the current situation. On top of this, there are lots of smaller pieces of news. So Alibaba continues to be hauled in for conversations with the government, which is obviously not a good look. It scares investors off because all of the additional regulation that's been laid on through the past year to 2 years has decreased the profitability of these businesses that need to adapt. And so we can see investors becoming more cautious once again in the prices of various assets within China. What's particularly interesting is that there is going to be the 20th National Congress later this year, and the performance of the government is not looking so hot through the past 2 years. Now, there's only one ruling party in China, so it's not as though it's going to be voted out. But what does this mean for the current leader's ambitions? I guess time will tell. All right, so there's a hell of a lot going on right now, and that has been going on for the past year and a half. There was coronavirus, high inflation, interest rates rising at record rates, GDP growth slowing down enormously, fears of a recession growing. China's having a challenging time, and because China's connected to just about every other economy in the world, any problems that they have will compound issues within other markets. So there is a lot of fear out there at the moment, but what has been quite interesting through the past few weeks, and I will look at the NSDQ100 while I talk about this, is that It does seem as though we are trying to establish a bottom. Now, this could completely change if earnings come in a lot lower than expected. So we saw some banks report last week, and more of them are doing so today. But here we can see that the index price fell off a cliff, tried to rebound, bear market rally, classic bear market rally, continued its trip downwards, but now over the past few weeks has continued to chop sideways for a while. And this is classic action when a market is trying to form a bottom. We've been hammered with a lot of bad news through the past few weeks too, but the price doesn't really make any material move downwards. Now, I know that these spikes are quite volatile, but I'm looking back and comparing them to the moves that we've seen through the past 6 months or so, and compared to that, they're not enormous. So I suspect that the worst is behind us, with the caveat being that if earnings are awful, and we're going to start finding out more about that this week, then the local bottom for this bear market is in. Something else I just wanted to throw up there for some perspective is that the drop in tech prices, there's been a fall in the price of just about all assets everywhere, but the fall in tech prices has been particularly difficult. And a lot of newbie investors, after losing 40, 60, 70% on their investments, will throw in the towel, saying that tech is rubbish. But if you were to collect a basket of companies, tech companies that have done well through the past 5 or so years, and map out their stock performance, you'll see that compared to something like the S&P 500, they have performed fantastically, even when you consider the enormous declines that we've seen through the past 6 to 12 months. Now, of course, looking backwards doesn't always guarantee what the world is going to look like going forwards in the future, but I own several of these companies that you see listed on the top left-hand side of the image, and I feel pretty confident that these companies are going to be huge players in the market for the next 10, 15 years. I think that they will be leaders in their respective areas. So while it is painful to feel the decline in the share prices, sometimes very large decline in the share prices over the last 6 to 12 months, my time horizon for success here is much larger. And the returns that I'm looking at over that period, if they were to give you these returns again over a 5-year period, that'd be a fantastic return. All right, so what's going on this week? We are getting a few interesting data points, but nothing as powerful as last week's CPI number out of the US. So we will see CPI numbers out of the EU as well as the UK. This number out of the UK is expected to be quite brutal. Jobless claims will be interesting. So the idea here is that as the economy slows, companies battle to grow, they need to get rid of some of their workforce, the number of jobless people in an economy drops. This would signal that the demand destruction that the US Fed is attempting to enact is working. And in terms of the UK, retail sales numbers will be interesting, as well as the PMI numbers. Now, while economic data this week is not likely to have a massive effect on prices of assets, the action in earnings through this week definitely can. So we can see today that there are a few more banks reporting, and last week was a mixed bag for banks. It wasn't as bad as it could have been, and some banks, like Citigroup, actually did very, very well. We can also see that some other behemoths will be reporting this week, including tech companies, so Netflix, Tesla, Twitter, American Express, Johnson & Johnson, etc. I'm not going to read out every logo on the screen, but you can see that it's action-packed, and we're going to get a lot of information, not just about our stocks, but about businesses in general within the US, how they're faring, but more interestingly, how they think they're going to do for the remainder of the year. My expectation is that we are going to see some downward revisions from the companies reporting this week and through the rest of earnings season. The question is just how large will those revisions be? All right, that's it for this week. If you're in Europe, enjoy your heat wave, and I'll speak to you soon. Goodbye.